Welcome back to the channel. The very first mistake you want to avoid when you file your business taxes revolves around income. So when we talk about income, we have a constellation of factors to talk about. For example, misreporting income. You don't want to do that because the IRS uses a computer to match what has been reported to them with what has been reported by you. So if the IRS algorithm sees a gap, sees a discrepancy, this could be problematic for you. Okay, for business owners, this is often done via various 1099 forms, the reporting of the income. So some of your income may be reported to the IRS and to you for that matter on the form such as the 1099 NEC, which lists non-employee compensation. You will also likely receive 1099s from your investment accounts as well as a 1099-R for retirement account. So you will need to include all that income in your tax returns. Very important. And please do not list that income in the wrong place because this could lead to additional IRS scrutiny or even audit. You don't want that. Failing to report all of your income, this is also not good at all. Listen, when you run your own business, it may be tempting to under-report your income. Never do that. Some business owners may even try to get paid in Bitcoin or another virtual currency. Don't play that game. Don't play that game. You don't want to play games with the IRS anyway. Over-reporting your income could also be a problem, okay? So you want to avoid that. Not keeping charitable contribution receipts could also be problematic. For charitable contributions more than $250, you are required by law to keep a written acknowledgement from the nonprofit in order to take a deduction. So, boss, I want you to see in your records if you have donated more than $250 to a charity, make sure that you have a written acknowledgement from them. Forgetting the value of small items, this could also trigger some audit or at least additional scrutiny. Forgetting all of your tax obligations. See, here we are speaking about income taxes, but there are other taxes you have to comply with, right? You have to pay. So you have self-employment taxes, you have local taxes, you have excise taxes, you have property taxes, you have payroll taxes. So there is a constellation of taxes that you got to make sure that you stay on top of, okay? And not realizing limitations on deductions, especially when it comes to income, could also be problematic for you. So don't do that. The second mistake that a lot of filers do when it comes business filers make is around the legal structure. So not selecting the proper entity. When we talk about businesses, we are speaking about C corporation, LLCs, partnerships, right? And not many small businesses form as a basic C corp or LLC, but this could be a mistake. Okay, an experienced EA, enrolled agent, CPA, certified public accountant, or tax attorney can help you determine the best business tax entity for your company based on your desired business structure, number of employees, and financial goals. Okay, so there are many potential entities to look into. For example, sole proprietorship, C corporation, nonprofit for that matter, nonprofit, LLC, partnerships. So choosing the wrong tax entity for your company can seriously impact your company's future. This is really important. This is why I'm just saying, if you have no idea what I'm talking about, make sure that you enlist the help of an expert. The third mistake, deductions. Very important. Overestimating the home office deduction could lead to trouble. Don't do that. Okay, there is actually a persistent myth out there that taking the home office deduction is a big audit red flag. No, like any tax break, abusing the deduction could get you into trouble with the IRS. Conversely, if you work from home and are eligible for the home office deduction, go ahead and take it. Yeah, not having a mileage record. Okay, many small business owners have personal vehicles that they sometimes use for business purposes. So if you want to claim a mileage deduction, you will need to keep certain records of your driving because the IRS requirements are pretty strict. Actually, if you are interested, you can see everything in publication 463. Okay, now attempting to deduct 100% of your meal expenses. This could also lead to problems. Remember that the deduction actually is capped at 50%, not 100%. If you deduct more than that, you could be actually in trouble. not claiming the qualified business income deduction, the QBI. Okay, the QBI, also called the Section 1998 deduction for owners of pass-through entities such as LLCs and S corporations, is based on your business income. It's not a technically really like a proper tax deduction, but it can be a valuable way to lower your tax liability nonetheless. Okay, so the QBI tax break value will vary depending on your income level, business structure, and type of business. Mistake number 4 revolves around record keeping. This is a big one. This is really a big one. So when we talk about record keeping, we have a series of mistakes. For example, ignoring your bookkeeping throughout the year. This is kind of crazy. Like, it's funny. People are trying to do their bookkeeping manually, and then comes tax time, they realize, hey, listen, I was not able to keep track of my expenses, and now they're panicking. Nowadays, you have options. Boss, you have options. If you are a small business owner, you can either outsource the whole accounting function to a third party. You can actually hire a local accountant or a CPA if you have the resources, or you have a complex accounting system, or you can just do things yourself, DIY, with online software such as QuickBooks, Xero, Wave. And those software tools make it a lot easier for you to track your spending and income. Okay, this is really good. And the good thing is that the software can do the math for you. You don't have to worry about that. So ignoring your bookkeeping throughout the year could be problematic. Why? Because come year end, and you have to actually start putting data in your business, on your business tax forms, you need to have accurate data. That's number one. Number two, if God forbid you get audited, how are you going to substantiate the amounts you put on your tax forms? This is why it's important to have something structured when it comes to your bookkeeping. Failing to keep cost basis records could also be problematic. Okay, owners of pass-through businesses can only claim a certain amount of losses on their personal returns. Remember, when we speak about pass-through businesses, we're talking about LLCs and S corps. In other words, you're not paying taxes. You're not paying business taxes at the business level, but you're paying taxes on your personal income tax return, right? So when you file your Form 1065 or you file your Form 1120S, those are called informational forms, but you pay the real tax at the personal level. Okay, so mixing personal and business finances is also problematic. This could get you in trouble. Don't do that. If you have a business, you want to have a business credit card, you want to have a business bank account. Now, if you cannot get a business credit card, you can get a personal credit card, but only use it for business purposes. Okay, so there is a clear segregation between your business expenses and your personal expenses. Very important. Mistake number 5, tax planning. Tax planning is another big one, and a lot of small business owners actually underestimate the importance of tax planning. So if you don't do any tax planning throughout the year, this could be problematic for you. Many people treat tax preparation like record keeping and only complete their tax forms with information that happened last year. Now, consider working with a tax professional who can help you with tax planning. When we talk about tax planning, we are talking about lowering your tax liabilities in the long run, making the right choices, planning your future tax-wise, your business's future tax-wise. Think of that person like a coach. Think of the CPA, the EA, the enrolled agent, or the tax attorney like a coach who is helping you actually figure out the best way to win. Okay, so doing so may lower the stress that you may feel when filing your taxes, your business taxes especially, as well as ideally lowering your overall tax obligation. Okay, very important. At the very least, the tax planning professional should help you avoid a shockingly terrible tax bill when you are not expecting it. And this is why you need help. Again, I'm speaking here about something that I'm assuming you have no idea about. If your forte is not tax planning, it's not accounting, it's not business financial record keeping, you want to outsource the tax to somebody else. Okay, now filing your taxes during tax season should not leave you shocked by what you end up owing. So this is why you want to work with your tax preparer and tax planning expert to look for ways throughout the year to minimize your tax bill. Okay, proactive tax planning, at least that's what we have seen in our research. Proactive tax planning at best can help lower your overall tax liability. On the worst end, avoid a surprise and scary tax bill when you eventually file. So tax planning, we have seen in our research, may also help you prepare for, like, if you can actually file taxes earlier instead of waiting until the last minute, or asking for an extension. Don't do that. Another mistake around tax planning is about overlooking carryovers deductions. Several tax breaks are limited, or you may not have been eligible to fully utilize them in a prior tax year. The good news is that they may be deductible now. So a few common items to check for include capital losses, net operating losses, the NOL, investment interest, and the home office deduction. So this is why if you have a tax planner, this could be really thought about beforehand. Mistake number 6. We are talking about startup costs. Okay. Now, ignoring business startup expenses is really bad for you. In your first year of business, it is easy to miss money spent getting the business up and running. Okay. So those expenses are deductible. Very important. So deducting startup costs incorrectly could actually lead to trouble. Okay. This is very important now. Owners commonly overestimate how much of their startup costs are deductible. Despite misconceptions, business owners cannot deduct all startup expenses right off the bat. You cannot. First, you have to make a sale. Then those expenses are deducted over the course of the next 15 years. In other words, they are amortized. You cannot actually deduct all of them at once. Okay. There is a caveat, however. The IRS will actually allow up to $10,000 in deductions from startup costs in your first year. Okay, so that's $5,000 for startup and $5,000 in organizational cost if your total expenses do not exceed $50,000. And if your startup costs were more than $50,000 but less than $55,000, you can still receive your deduction, but it will be reduced by the dollar amount exceeded beyond 50 grand. Okay, again, what I'm telling you, if you have an experienced enrolled agent, tax planner, tax attorney, CPA will sometimes recommend strategically waiting on your startup deduction until the second or third year of your business, depending on your current finances. Mistake number 7, choosing the wrong retirement plan. This could be another mistake. So retirement plan contributions are one of the easiest ways for small business owners to both plan for the future as well as reduce their current tax liabilities. So you want to actually, again, if you're not familiar with the whole thing, I want you to work with a trusted CFP, a certified financial planner, to make sure that you choose the right retirement plan for your small business. Because choosing the wrong plan could limit your deductions or require you to make contributions to your employees that you cannot afford. Okay, this is really important. So good news is that you may also qualify for a tax credit when starting a retirement plan for your business. Okay, so in many cases, what we have seen in our research is that the solo 401k will allow for the largest contributions for a small business. So if you are doing well and already maxing out the solo 401k plan, check out a cash balance plan, which can potentially allow you to shelter hundreds of thousands of dollars of income each year. Mistake number 8, we have filing. So the actual filing of your business taxes. And again, here we have a series of mistakes, small mistakes that make up the larger mistake. Okay, underpaying estimated tax, this could be really problematic. And so paying quarterly taxes is actually the bane of many business owners' existences, and writing large checks to the government is never fun. Been there, done that. So for those who need to pay estimated taxes, make sure you have an account that will actually encompass all the taxes that you will still owe. That includes what? Self-employment tax, Medicare taxes. So we have 0.9% on earned income and 3.9% net investment income above certain levels. If you don't pay your quarterly taxes throughout the year, you can trigger tax penalties, and nobody wants that. It's never fun. Okay, so this is really important. So it's the thing is, it's better to pay actually too much than pay less, because you are basically avoiding tax penalties, which can be very, very stiff anyway. So failing to attach required forms, schedules, or election statements can be a problem. So a tax return is not without all the necessary paperwork being submitted. Okay, so if you file, let's say you file your form 1065 and you have not attached the necessary schedules, the IRS will not consider that form 1065 submitted. In other words, you can be liable for penalties. So if you are working with a tax professional, they will take care of that for you. Okay, because that assumes that you have provided them with all the tax forms, of course. And so, in addition to underpaying estimated taxes, failing to attach required forms, schedules, or election statements, if you put off taxes until the very last minute, this is also a mistake that you need to actually avoid. Also, filing your taxes late, not good at all. Not good at all. So you want to watch your tax filing deadlines. If you are unable, if you cannot file your business taxes on time for any reason, ask for a filing extension. The more complex your business or businesses, the more likely you will need to file an extension each year. Be sure not to use that as an excuse to procrastinate, and make sure that you file by the time your extension ends. One thing I need to say here is that if you owe money to the IRS, you still need to pay the money by the due date, though, by the April 15th or the March 15th, depending on your business's structure. Okay, but you can still file at a later date, but you need to pay now or by the due date. Mistake number 9 that a lot of business owners make, that you should avoid: staff cost. Okay, now keeping clean, organized, and precise records is not every business owner's strong point, but it is something you need to do. So in the middle of a busy day, it can be very easy to forget to add the extra receipt of purchase to your files, or update your QuickBooks as much as needed when it comes to employee cost. So you have a lot of stuff to worry about, but do not make a mistake of actually losing or not keeping track of your staff cost. Okay, so we're talking here about, you want to keep every paper, folder, file, invoice, and pay stub in the right location. Now you can outsource the whole thing. Again, my point here is that if you are busy running your business, thinking about growth, thinking about new clients, think about how to increase income. You don't want to think about back office work and think about how to file paperwork and all that kind of stuff. This is why, again, you want to actually outsource the whole thing. So when we speak about staff cost, we also talk about not understanding the differences in federal and state tax rules, especially as they pertain to payroll taxes, as they pertain to unemployment insurance, and all the ancillary taxes around that. Also, another mistake that people make when it comes to filing their taxes, the number 10, compliance. Compliance is very important. So not staying up on tax development. In other words, basically the IRS tax rules change all the time, and you need to make sure that you stay on top and you know exactly the latest trends, the latest rules, the latest guidelines that the IRS has published. Very important. Okay, and so if you also, there might be some mistakes when you don't disclose everything to your CPA, you don't disclose everything to your EA, you don't disclose everything to your tax attorney. It's very important because they will actually be representing you. So you need to be fair to them. At least at the basic, you need to be fair to them, to give them all the info they need to do a good job. And also, there are some legal implications here. So if they are representing you and you do not provide them with all the paperwork they need, if something happens down the road, they might not be liable. In other words, you might be liable. You. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about the top 10 business tax mistakes you must never make, at least this year or never. So your income, so those mistakes revolve around your income, your legal structure, deductions, record keeping, tax planning, startup cost, retirement, filing, staff cost, compliance. Thank you so much. I'll see you next time, but until then, remember, stay marvelous.